Welcome to our comprehensive breakdown of the 2007 to 2008 financial crisis, one of the most significant economic downturns since the Great Depression. In this video, we'll explore the causes, major events, and ultimate recovery from this global calamity. The financial crisis of 2007 to 2008, often referred to as the Global Financial Crisis, GFC, emanated primarily from the collapse of the United States housing market. But what exactly triggered this collapse? To understand the reasons behind the housing market crash, we must start with the concept of subprime mortgages. These are loans offered to individuals with poor credit histories, usually entailing higher interest rates because of the elevated risk. For several years leading up to the crisis, banks and other financial institutions aggressively promoted and issued subprime mortgages. Initially, this was seen as a positive move. Allowing more individuals to own homes seemed beneficial. However, many overlooked the inherent risks associated with these financial products. Beginning in 2005, the U.S. Federal Reserve began raising interest rates to combat inflation. This had a direct impact on adjustable-rate mortgage (ARM) holders as their mortgage payments shot up dramatically. The rise in monthly payments led to a surge in loan defaults and foreclosures. A key catalyst behind the widespread ramifications of these mortgage defaults was the securitization process. Financial institutions packaged these subprime loans into mortgage-backed securities, MBS, and other derivatives, selling them to investors worldwide. When homeowners began defaulting on their loans, the value of these securities plummeted. Credit rating agencies, which are responsible for evaluating the risk of investment products, assigned high ratings to many of these MBS products. Consequently, investors, including large institutions, pension funds, and banks, heavily invested in them, unknowingly exposing themselves to significant risk. Let's examine the timeline of key events that characterize the escalation of the financial crisis, starting from the initial signs of trouble to the full-blown global crisis. In 2007, early indicators of financial instability began to surface. Bear Stearns, an investment bank heavily involved in mortgage securities, reported significant losses in two of its hedge funds due to mortgage investments. By August 2007, BNP Paribas, a major French bank, froze three of its funds, citing a complete evaporation of liquidity. 2008 brought the collapse of major financial institutions. In March, Bear Stearns was acquired by J.P. Morgan Chase at a fire sale price. On September 15, 2008, Lehman Brothers filed for bankruptcy, triggering a wave of panic and causing stock markets to plummet worldwide. Governments around the world took unprecedented measures to stabilize the financial system. The U.S. government implemented the Troubled Asset Relief Program, TARP, a $700 billion bailout to purchase toxic assets from financial institutions. Similar measures were taken by other countries to inject liquidity and restore confidence in the banking sector. Despite these interventions, the global economy entered a severe recession. Employment rates plummeted, as did consumer spending. The global GDP growth rate fell sharply during this period, affecting nearly every sector of the economy. One of the lasting impacts of the crisis was the regulatory overhaul that followed. The Dodd-Frank Wall Street Reform and Consumer Protection Act was implemented to increase oversight of financial institutions and prevent a similar crisis in the future by imposing stricter regulations on the finance industry. Let's take a moment to answer some frequently asked questions about the financial crisis. Question 1. Could the financial crisis have been prevented? Answer. While it's challenging to predict the exact course of events, many experts agree that stricter regulations on lending practices and greater oversight of financial institutions could have mitigated the impact or possibly even prevented the crisis. Question 2. What lessons were learned from the financial crisis? Answer. Several key lessons emerged, including the need for better risk management, the importance of regulatory oversight, and the dangers of excessive leverage and poor quality credit products. Fast forward to today. The economic landscape has made significant strides in recovery. Although the crisis left deep scars, both financial markets and regulatory frameworks have adapted to create a more resilient system. Thank you for joining us in this deep dive into the 2007 to 2008 financial crisis. We hope this video has provided you with a clearer understanding of the events, causes, and consequences of this historic economic downturn.